Good afternoon, everyone. Hope you're doing well. I wanted to give you a general market update and look at some key charts. And of course, just first up, the disclaimer, this is not investment advice. It's for educational and data purposes only. So if you're not a client and you're watching this, it's just for education. Let's have a look at the markets. So if we jump into it, let me just delete that off the screen so we don't have to look at that. Let's start with the price of gold, and I won't spend too much time on charting principles today. I'll just run through a lot of charts, but if you want to learn more about some of these charting concepts, the techniques I'm using, please do reach out for a private chat. Now, the price of gold has had a very good run of late, and I've been advising my clients, we normally have up to a 20% allocation to precious metals, and I've been advising that we reduce that to 10%. And gold's had a nice run. You can see from the low in July, it moved up almost 20% and is still up 16.5% from there. But what we've started to see is a little bit of, as it makes those all-time record highs, a little bit of negative divergence forming on the momentum indicators. And generally that's a sign that the uptrend is losing some momentum and that it's probably not the best time to have your largest allocation. And if we go to a 5-year chart of gold, so if we zoom back, we can see just how sharp up this run has been. And you can see around the $2,000 level was key. We've looked at this in many previous videos. Lots of resistance there at 2,000, and then once it broke through, bounced off the ceiling became the floor, bounced off and up it went. But it's definitely had a good run. So just exercising some caution at the moment. Silver, similar sort of story. I've been advising clients to reduce exposure, not sell completely, just keep the exposure reasonable. And you can see silver also been on an uptrend. But what concerned me recently, and I spoke to a few clients about this privately, was the breakout above I believe that was the 12-year high, broke out above the uptrend channel. And I said that was probably a little bit overdone and it needed to come back to have a test of the previous highs. You can see that sort of around that $32 level was key. If we draw a line across there, the $32 level, you can see that was resistance in May of this year and July. And I would say it's probably coming back for a test of that. I guess an aggressive trader would look to buy in at this level, but I'm just exercising a bit of caution that maybe we're going to break down from this channel. So again, just be a little bit, this is positive for the longer term for silver. And if we look at a 5-year chart, we can see that around that sort of $28, $29 level was pretty key. We've broken out of that. You could even draw the line a little bit angled there and say we've broken out. I don't know if it's going to come back here for another test of the $27-ish level, but I would say that that's a possibility. So just be a little bit cautious. Again, not investment advice. I'm just letting you know what my clients and I are doing. Let's jump across to the US dollar and look at a 1-year chart. Now, this is something I talked about in previous videos. I was concerned that the US dollar downtrend was coming to an end. You can see this sort of broadening structure, which generally indicates that a bit of a bounce is coming. Price making, you can see this little pattern here, price making lower lows, momentum indicators making higher lows. And that indicated that the downtrend was losing momentum and that it was likely we were going to see a bounce. And you can see, of course, we did see a breakout. Now, I thought it might stall initially at this 104 level. You can see the 104 level was pretty key. But last night's price action indicates that it looks to be breaking out from there. So hard to say where it's going from here. Maybe we'll see some more US dollar strength. But certainly the downtrend ended in the short term or medium term downtrend ended a few months ago in the US dollar. We've seen a rally, so be cautious. Or I'm advising my clients to be cautious. US dollar strength generally means downward price pressure on a lot of other major asset classes. Stocks have done well. Let's have a look at the US, the S&P 500. So US stock market, you can see the low in August. Look at that though, a little bit of a breakdown last week or this week, depending on when you're watching the video. So you see these rising wedge patterns are generally pretty bearish. You can also see that the momentum indicators, so as the price was making a higher high, momentum indicators rolling over, indicating that the uptrend was losing momentum. And then you can see that the gap down and now trading below that level. So, and if we go to a 5-year chart, you can see just how extended this US market is. It's had a massive run from the low in October. So 2 years ago, it's up 61%. I can't give advice on this video, but my clients and I are playing it relatively safe with our stock exposure. We're in covered call funds, so we're looking more for income than growth at this stage. The NASDAQ, so the US Technology Index, a very sort of similar picture. You can see, again, it's touching that previous all-time high. It's got this sort of rising wedge-like pattern. This is a weekly chart, so we'll zoom in and have a look, but you can see as the market has been making higher highs or touching the same highs, momentum indicators are making lower highs. Again, this is not, it's hard to say where it's going to go, but these are typically sort of bearish signals indicating that the market is expensive. So my clients and I are being very cautious when it comes to that. If we zoom in onto the daily and we remove those lines, you can sort of see the same thing on the daily. Price making higher highs there after a good run. Momentum indicators flattening out, indicating that the uptrend losing momentum. So you can see that pattern there. And you might even argue, I mean, that's sort of the similar sort of wedge pattern that we saw on the US market. Again, it's broken down from that. You could say even in the short term, there was a little squeeze there, a little rising wedge pattern, which is generally bearish as the momentum indicators are rolling over. And it's broken below that little channel there. So I'm not calling for a US stock market crash. I'm just suggesting that caution is the name of the game at the moment. If we look at the Australian market, it's had a little bit more of a significant sell-off. Now, in the short term, you might argue that there was a little head and shoulders pattern there. This is on the daily chart, and you could say that was the neckline and threatening to break down from that. You can see that these were the previous key levels, the previous highs, previous high there, previous high, breaks out, returns to test, return to test, and now we're back down there again. So I guess if you were very aggressive, you'd be buying that short-term low there, but I would be very concerned that especially during the trading day, you can see that candle wick, we did trade quite a bit below that level. And again, same thing on the Aussie market. You've got, as the price was, that was a all-time high for the Aussie market, as the price was making all-time highs, momentum indicators making lower highs, so negative divergence indicating the uptrend is losing momentum, then it was probably time to take some off the table. And if we delete those lines, we can see the same sort of rising wedge or rising trend pattern. Look at that. You've got that rising wedge, generally a bearish pattern. So multiple sell signals there on the Aussie market. And of course, had you sold the all-time high and you were looking at that rising wedge pattern, you were looking at the negative divergence and you sold some there, well, that's so far proved to be a wise decision. Chinese market, you've talked in previous videos about the massive pump in the Chinese market. I'm going to go to a 5-year chart so you can see the distortion, let's call it, from all the stimulus. And if we draw, you can see this is a pretty key sort of downtrend. If we draw that, we can see the Chinese market was in a downtrend. And if you're a client of mine, you know that we were buying some around this level. I didn't know that the big stimulus package was going to come right at that time, but we did make some money going along the Chinese market. But you can see it was in a downtrend, lots of touches there, touch there, failed to touch the channel. Again, it actually made you can see there was a double bottom. And what did you get there? You got some positive divergence on the momentum indicator. You were buying at a previous low. All right, so that was a buy signal there. And I was looking for something like that. I guess I was more buying around here, and I'll show you why. If we zoom back, if you don't have that data, you can see I was probably saying buy around there because I was seeing positive divergence. Of course, it went a bit lower. I didn't quite capture the low, but then there was a massive pop. Now, I wonder if the Chinese market is just, look at that previous key high. Look at that. What a coincidence that it's trying to bounce from that level. Now, we'll see what happens in the next few weeks or probably the next few months. But I would say this is a breakout from a long-term downtrend. And my clients and I are maintaining a small allocation to emerging market stocks, roughly 5 to 10%, not necessarily specifically in China, but some of us do have a China fund. In fact, some of us sold it up here and bought it back. So again, that was a little bit fortunate. Debt markets. Let's have a look at TLT, which owns long-term bonds under heavy pressure. And we'll look at bond yields in a moment. But this is a short-term chart. And we can see now, I'll show you a comparison between the US dollar and US bonds. So right now, there's a dynamic where if the US dollar measured by the US dollar index is going up, bond prices are coming down. So let's firstly look at a chart of long-term US government bonds. This is TLT. You can see it's been in, well, a very sharp downtrend on the daily chart. A little bit hard to even draw a channel there. It's quite severe, but you can see the momentum indicators are starting to round out. In fact, you could even say on the RSI, there's already some positive divergence forming, a little bit early on the MACD, but keep in mind, this is a major low down there. So maybe it's going to go another, 3-4% down to test that low. We'll find out. It's certainly in a sharp downtrend, but I am looking to, sorry, just getting a bit distracted by a few other things over here. I'm looking to allocate, my clients and I, we've been increasing our allocation to bonds just because bonds have been such a poor performer. While you see gold going up, you see stock markets hitting all-time record highs, bonds have been going down. Makes sense to, as I showed in those previous charts, you sell some of your stocks, or we have been, selling some of our stocks, moving some more money over to bonds, over to the income investments. So let's have a look again at if I do a comparison and I throw the US dollar on top so we can show the relationship. Now, I don't like these default colors. It's a little bit hard to see. Let's go to black. You can see, well, John, what are you talking about? Well, watch what happens when I flip the US dollar upside down. Look at that correlation. The black line being an upside down chart of the US dollar, and then of course TLT. So if the US dollar is going up, bond prices are coming down, and if the US dollar is going down, bond prices are going up. That's been the dynamic, at least for, if we scroll back through, we can see even last year that dynamic was happening quite a bit. So if it just kind of helps you reallocate, it helps you balance your portfolio, make sure you have the right allocations. If you understand these trends and these dynamics, it's always good to do comparison charts like this. So I would suggest, and I've had this argument with a few clients I have a few clients that don't want to buy bonds, but they are very bearish to the US dollar. So they think the US dollar is going to go down. And I try and show them this chart and say, well, if the US dollar is going down, that means bond prices are probably going up, given the strong correlation we see here. So why aren't you buying bonds? That's what it's important to look at these dynamics and try and figure out what's going on in the markets. So let me just remove that comparison. Bitcoin, I don't understand why it's going up so much. I'm not opposed to buying some crypto. My clients and I have a very small allocation to crypto, but I'm not a believer in the Bitcoin success story. And silly me, could have made a lot of money having a lot more Bitcoin. But if we do look at the chart objectively, we can see from March this year, Bitcoin has been in a pretty solid sort of downtrend. And it's a little bit of a broadening structure, which is generally bullish. But you can see as the price was making, now where the signal should come is it barely tested the bottom of that channel there. It sort of made a double bottom. And at the time it was making a double bottom, we were starting to see, look at those momentum indicators, positive divergence on the momentum indicators, hitting a previous low, been in a sort of a bearish channel for some time, that had to come to an end. So that was a buy signal. And then of course, we see the same old thing again, break above the roof or resistance, return to test, and then went on to make a new high. So I would remain concerned that, this is an all-time record high here. I don't like to be buying any investment at an all-time record high price. Same with gold. I talked earlier in the video about how gold's been hitting record highs, so I've been recommending my clients reduce their allocation to gold. You want to buy low, sell high, and I would say Bitcoin has had an excellent run, and that's probably not the best time to be having your full allocation to an asset when it is at an all-time record high. Um, Probably won't look at the gold miners, but again, I've recommended my clients sell the gold. The gold miners have done worse than gold in the short term. You can see from the high in October, they're down about 10%. The price of gold's only come back, I believe, about 2% from the all-time high. So the miners, a lot more risk in the miners. Might save that for another video. This is the price of oil. So oil has fallen substantially since July. It's down about 20% in fell 20% in price. It's a little bit off the lows. But if we have a look at oil here, we can see, again, we're on the daily chart. We can see downtrend. Now, it did try to break out, and now it's returned to come back into the channel. But the way I look at this is it's a broadening structure, which is a falling broadening wedge is generally bullish. And now we can see in the short term, it's trying to establish a little bit of an uptrend. And of course, as it was hitting these lows, you could say with the spikes that it was roughly the same low. You might be able to draw it like this and say, okay, well, it's hitting the same lows roughly there, and there is some positive divergence forming. But looking at that chart, direction on oil is not clear. And just give me a moment to jump across to this other screen that you can't see on the video. So when I look at this chart, I think like when you saw that, you say, okay, well, maybe the downtrend's ending, but it has returned into, it's looking a little bit bearish in the short term. So I look at this chart and say, I don't know where the price of oil is going. Could it break down from that support there? Let's have a look at a weekly chart and let's zoom in a bit further. I would say, there's quite a bit of support around the $65 level here. Lots of previous lows here through 2023, but a little bit unclear, hard to say where oil's going. And of course, we could have a look at copper and platinum and palladium, but in the interest of keeping this video short, I did want to briefly touch on bonds and have a look at something that I got wrong. So I probably started buying bonds. So a lot of my clients, a few months ago when that dollar was hitting the low and bond prices were up, we reduced our exposure. We took some profits, and I've started buying that back. So what happened was, let's have a look at a chart of the 10-year yield, so the interest rate on 10-year US government bonds, which is a key interest rate. And of course, we are buying some ETFs, some investments that are allocated to this particular area. So keep in mind, when interest rates or yields are going up, bond prices are coming down. So we looked earlier at TLT, and we saw that TLT had been coming down in price sharply, and that's because interest rates or yields are going up sharply. So they move in, just think of a seesaw. Bond prices going up, that means interest rates are going down. If bond prices are going down, interest rates are coming up. Sorry, I didn't explain that too well, but a seesaw effect. So they move opposite to each other. So what happened here was we saw that bond yields were in a downtrend and there was a recovery. So when they got to here, I thought, okay, well, they're in a downtrend. And I started buying bonds because I saw that they were hitting this level here. And of course, they've broken out and had quite a run. So I was incorrect on that. I've started buying the bonds too early. I didn't expect interest rates to have such a sharp move. I mean, look at that from September. You're talking about 6-7 weeks, 21% increase in the interest rate on a 10-year US government bond. And that's reflected in the price of, well, I can stay on this screen. If we look at the price of TLT, TLT holds 20 and 30-year US government bonds, but they're similar dynamics. In fact, if we do an overlay, if I go back to that 10-year yield, and I'll show you the relationship, even though TLT holds 20 and 30-year bonds, the 10-year bond is still trading very similar to TLT. And if we do a comparison chart and we go TLT, new price scale, and if we'll just leave that color, I'm sure you can see that fine. And if I flip it upside down, because remember I talked about how if bond prices are going down, interest rates are coming up and vice versa. So if we invert the scale, look at that correlation there. An inverse relationship between yields and bond prices. So what that means is that if you're looking at a chart of let me just remove that so you can see this better. And let's remove that. So if you're looking at a chart of interest rates, if you're thinking this chart, see how the momentum indicators are starting to roll over. It's a little bit early yet, a little bit of negative divergence on the RSI. So indicating that this is that the yield is looking like a sell soon. It's a little bit early, but there's going to be lots of key highs here that it has to get past. And I think there'll be some selling pressure on yield. Well, you don't really sell yields necessarily, but there'll be some resistance there for the yields, and there should be a little bit of buying pressure coming into bonds. So we'll see how that plays out. I did start rebuying too early, so that's something I got wrong. And if you're a client watching this, I apologize for starting to buy a little bit too early. It's very difficult to predict these things. And if we look at the Australian 10-year, similar thing. Wow, look at that. Look at the move up in interest rates. So the RBA hasn't cut rates yet, but you can see since September, so we're only talking about 6 weeks or so, the interest rate on a 10-year Australian government, what was a surprise, 21% as well. It's almost as if all these markets are connected. The 10-year Australian interest rate goes up 21%. So does the US one. I don't think that's a coincidence. I think markets are all very intertwined, very connected. Investors are looking at the same thing. They're seeing rates go up in the US, so rates have got to go up in Australia. Now, I would say this one is, again, quite extended. It does look like it's broken out a little bit from the previous high. But again, have a look at how sharp that trend is. Very extended. Maybe it's got more to go, but you can see starting to roll over here on the momentum indicators. Probably is a little bit early days to be calling that. But that just gives you an idea of where things are at. And of course, I can't really show you ETFs or investments in this video because I'm not allowed to give investment advice on a YouTube video. But if you do want to learn about some of the funds that my clients and I are buying to trade or invest for these scenarios, please do reach out for a private chat. And aside from that, if there's any other charts that anyone would like to look at, let me know. But hopefully that's a simple summary of major markets, where they're at, where the current trends are. And thank you very much for taking the time to listen. And we'll wrap it up there. Have a great weekend or a great week whenever you're watching this. Cheers.